Best Buy just printed a massive holiday earnings beat, but not by selling you a TV at full price. They did it by quietly turning themselves into a high-margin ad network. It is March 3rd, 2026. You are listening to Earnings Unscripted, where we unpack what actually happened in today's earnings. We are looking at Q4 results for the electronics retailer Best Buy, ticker BBY. And Meryl, look, Q4 is always their giant holiday quarter, but the kind of leverage they pulled off here is pretty wild. How did you read this print?
Look, it was actually a masterclass in survival. Top line hit $13.81 billion, which is, a huge 42% seasonal jump from the $9.67 billion in Q3. But the real story, the absolute wild part is the operating income. They drove it up to $721 million. Operating margins hit 5.2%, which is, up from 2% last quarter. EPS landed at $2.56 a share, compared to just 66 cents.
Just a quick reminder right up front, this is all just our personal opinion and absolutely not financial advice. But looking at those headline numbers, Miro, the stock price action today was completely bipolar, wasn't it?
Yeah, total whiplash. The stock had been bleeding out for months, basically down 20% over the fiscal quarter. Then, pre-market today, it violently spiked up to around $71 on the EPS beat. Then, the machines actually read the gross margin print, panicked, and dumped it all the way back down to open near 64. But it clawed back a modest 2% gain by the closing bell.
Hold on, so why the sudden panic on margins? You just said their operating margins were way up.
Operating margin was up because they aggressively leveraged their overhead. They just gutted SG&A costs. But the actual gross profit rate on the physical goods dropped down to 20.9%. Big tech is hiking memory component costs right now, so retailers are forced to slash promotional prices just to move laptops and phones. They're getting squeezed hard on the hardware itself.
Right, which forces consumers to basically only buy what they absolutely need. Management actually called it a duress market for appliances. Like, you only drag yourself out to buy a new fridge if yours literally caught on fire over the weekend.
Exactly. They're basically running emergency logistics at this point. And yet, foot traffic is getting a really bizarre boost from their new third-party digital marketplace. People buy something online from a random, unowned vendor, realize they hate it, and then physically lug the return back to a local Best Buy store. Over 80% of marketplace returns happen in person.
That is honestly brilliant. It is a total Trojan horse just to trap you back in the physical store. Okay, let's actually get into the details and figure out what they're building on these store floors, because it sounds like retail is changing.
Right. Well, what they are actually building is empty space. Or, sorry, I should say they are letting other people build in their empty space.
What do you mean, empty space? They are a massive electronics retailer.
Yeah, but they are literally ripping out the physical hardware shelving in about 70 of their trial stores right now. They're completely hollowing out the center aisles. So they consolidate computing into the middle, and then they take these massive, newly opened floor blocks and just hand them over entirely to vendors, like comprehensive assortments from Meta. They're just letting big tech set up private sub-franchise showrooms right in the middle of a Best Buy.
Okay, hold on. So you walk in for an HDMI cable, and suddenly you're inside a dedicated Meta VR experience?
Exactly. And the brilliant or maybe cynical part is that Best Buy does not even pay the staff for this. Vendor-provided store labor jumped 20% in the back half of last year, and management expects it to climb again. So Best Buy is basically acting as a physical landlord for Silicon Valley at this point.
A landlord for Silicon Valley. That is wow. But honestly, it makes total sense. Because if you think about it, hardware is getting so weird and experiential. Like the AI glasses and VR headsets, people need to physically put those on their faces before dropping $1,000. Big tech needs a physical showroom to survive, and Best Buy has the local real estate.
Yes, exactly. And they're pulling the exact same trick on the digital side, which brings us back to that ad network. This is the real secret machinery behind their survival right now.
Oh, right. Best Buy ads. You mentioned the high-margin Contra Cost win earlier.
Look at this. They collected over $900 million this year just from their retail media network. $900 million! And they logged that revenue mostly as an offset to the cost of goods sold.
Wait. Can I just sanity check that? Nearly $1 billion purely in ad placements. That is practically a mid-sized media company hiding inside a retailer.
Pretty much. That is exactly how they mask the terrible physical hardware margins. You lose money discounting a PC, but the manufacturer pays you to put the banner ad for that PC at the top of your app. It is basically just margin arbitrage.
Jeez. So they monetize the physical floor space with vendor labor, and they monetize the digital traffic with ad fees?
Right. And now they are trying to push beyond their own digital traffic entirely. This is the part of the transcript that actually impressed me. They are placing heavy bets on what Corey Berry keeps calling agentic commerce.
Right. I saw that phrase in the transcript too. She said, let me pull it up here. As agentic commerce matures, we want to serve our customers in new ways, both on and off of platforms. What exactly does she mean by off of platforms?
It means they know perfectly well that in a year or two, you are not going to bother opening the Best Buy app. You're just going to tell ChatGPT or Google Gemini to buy you the best OLED TV under $1,000. So Best Buy is natively integrating with OpenAI and Google's Universal Commerce Protocol to make sure their catalog is the one the AI shops from. They even integrated a new checkout infrastructure called Wizard, so the transaction is frictionless.
So they are essentially trying to become the fulfillment API for the AI. Like, they don't even care if you visit the .com homepage anymore as long as they process the box.
Exactly. The front end will just be whatever chatbot you use. Best Buy wants to be the warehouse and the delivery van. In the background, I have seen worse strategies, but it requires heavy capital right now. Corey explicitly warned that fiscal 27 is the last major investment year, and the real operating income payouts won't actually hit until fiscal 28 and 29.
Which is always a tough sell. I mean, asking Wall Street to wait 2 years for the ROI on a tech pivot is a massive gamble.
It is. They are preheating the oven, but the guests are already sitting at the table.
That is exactly it. So we have this incredibly complex tech pivot happening inside a very traditional brick and mortar shell. So taking all that into account, where does this leave their actual trajectory heading into next quarter and the rest of the year?
Well, they are basically telling Wall Street to just sit on its hands for a year. The guidance for fiscal 27 comparable sales is pegged exactly between -1% and +1%, so essentially flat. They are completely holding the line right now.
Right. Because they are just waiting for these big macro hardware catalysts like the Windows 10 retirement and the new Copilot PC cycles to finally force people into upgrading. Corey was pretty blunt about the reality on the ground. She said, quote, "We expect to see a consumer who is still spending, but is value-focused and attracted to sales moments."
But wait, just to sanity check that, the slowdown is not entirely on the consumer. The supply chain is actually tightening up on them. Balloonist made a really revealing point about that guidance range. He noted that if they hit the high end of their sales guide, it reflects higher prices offsetting lower unit sales.
Oh, wow. Okay, so people are buying fewer physical devices.
Exactly. The cost of memory components right now is so wild that Best Buy has to charge more for laptops, which totally kills their ability to offer heavy promotional discounts, which then shrinks unit volume. I mean, Q1 operating margin is already forecasted to dip right back down to roughly 3.9%. It is basically a defensive crouch until 2028.
That is so wild. So they are renting out their center aisles to Meta, building out invisible AI search tools in the background, and just praying our washing machines randomly break this year so we're forced to actually visit a store?
Pretty much. The grand survival strategy of physical retail is just becoming a giant, highly monetized billboard that occasionally sells you an emergency appliance.
I love that. Best Buy, the interactive billboard. All right, I think that is the perfect note to leave it on. Stay tuned, everyone. We have a quick wrap up right after this. Well, if you want these earnings breakdowns to just automatically show up on your feed, go ahead and follow the show. And just as a quick aside, we actually use AI to help us comb through all these giant SEC filings, which honestly keeps us from drowning in the spreadsheets. We would love to hear your ticker requests at earningsunscripted@datamadness.ca, or just use the X link in our show notes. Thanks so much for hanging out, and we will catch you after the next bell.
Have a good one.